Thank you, Mr. Chairman. Question for the panel. The chairman asked a question about can you achieve the increased capital requirements? My question is, can you achieve the increased capital requirements without negative consequences to the economy and to lending?
Senator, we do have concerns that some of the items in the proposal will lead us to either increase the price or to reduce the amount that we lend.
There's a chart in the NPR that looks deceivingly simple. It says, here's the RWA before the proposal, and here's the RWA after proposal. It says 24% increase. That is a reduction in capacity of this industry to serve its clients. No questions asked. The capital that could have been used to create those additional RWA incremental has to be used to sustain the same activities we have today with no risk from the day before to the day after and what the enterprise does. That's the point we're trying to make, is that this is about using our capital, whether we have it or not, and whether we have it to meet the new requirements to support additional activity, not the old activity, which doesn't help the American economy.
Thank you.
I think one of the frustrations you hear from this group up here is this question should have been asked before it went out. There's no question. We have to hold 30% more capital than international banks in the United States of America for every loan. A lot of loans have now fallen between, have become unprofitable. So a lot of loans, when we talk to Bill, they don't make sense for our company anymore. Small business, CDFI, solar, wind, middle market loans, certain trades you do with pension plans, et cetera. The work should have been done beforehand. By law, the QIS was the qualitative impact study should have been done beforehand. We had 10 years to do this, and it's shocking to me that we're sitting up there 10 years and we're talking about what's it going to do for small business, and we have to analyze it today. It shouldn't now. We all are going to fill hundreds of pages, thousands of pages of forms responding in a very detailed way to every single one of these things, but it was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
And before I go to Ms. Fraser, my assumption is everyone's going to say, with consequences, that will be negative. So let me ask a different question to you, Ms. Fraser. The impact, and perhaps the unintended impact from Basel, the end game, on customers. We so often talk about the American consumer as if there's just one generic consumer out there. But from a state like South Carolina, where we have a lot of farmers, the impact on farmers and access to not only credit, but liquidity during the hard times. Can you perhaps give me a 30-second reaction to, will this have a negative impact on some of the rural communities that need derivatives? Can you walk me through that for a second?
Certainly, and thank you very much for your question, Senator. This will, to your point, increase the cost of borrowing for farmers and rural communities. It could impact them in terms of their mortgages. It could impact their credit card. It could also, importantly, impact their cost of any borrowing that they do. And let me give you an example. For a farmer, hedging your commodity costs and your commodity prices is an absolutely fundamental piece of providing stability and ability to sleep at night. Under the Basel III proposal, the cost of the derivatives would increase quite materially, and that would therefore have an impact on farmers' ability to do a fairly fundamental component of risk management. It could also impact their access to credit. So it's the cost of borrowing, it's the access to credit, and it's some of the fundamental tools that they need to manage their stability of their income.
Mr. Solomon, you said something earlier that I thought was really important, that as we discuss the Basel Endgame proposal and its impact on lending and on folks like me that come from poverty or looking for the ability to achieve the American dream, someone would say, contrary to what I'm talking about, maybe there are other points that are important that I'm missing in my thought process, like, is it going to make our financial system safer? Have we not done enough work since the financial crisis of 2007 to 2009 to make sure that our financial institutions are able to meet obligations and responsibilities under an even worse case scenario? And your opening comments reflected that, yes, we can meet even a more disastrous crisis. Can you walk through the importance of the regulatory burden that exists and how the Basel Endgame would make it even harder for small business lenders or small business borrowers, but not necessarily making our economy safer?
Sure. Thank you for the question, Senator. I tried to highlight in my opening comments, and Mr. Gorman highlighted it quite clearly. These stress tests are very, very significant tests that look at very, very severe shocks to our balance sheets. I highlighted a 50% decline in equity prices over a one-year period, on top of then a simultaneous equity market shock that has looked at much as 30% instantaneous equity decline. So very, very severe shocks that we've not seen even in the worst crisis. That puts buffers in place that protect the system. Now, of course, a sound and secure system is imperative for our capital markets, and we can always have debates at the margin as to whether or not there are things that we can do that can strengthen the system. But a wholesale increase of 25% capital in the largest banks with lots of individual provisions that affect different activities, I think is ultimately punitive to economic growth and doesn't strike the right cost-benefit analysis. We, of course, need to make the system secure. The system is in good shape. We've seen that under stress. That doesn't mean there aren't things that can be done at the margin, but this is a wholesale change that leads to problems. Ms. Frazier highlighted one example talking about farmers. You can look at airlines hedging jet fuel. If you want to look at other derivatives, which obviously gets passed on to consumers, you can look at gas being hedged in utilities, which obviously gets passed on to consumers. And then you can look at other transactions. There's a provision under the rule called SFT, which allows institutions like ours to borrow securities from pension plans and give them cash. That increases the returns. It allows them to use their assets to increase the returns. Capital would increase by 8 times for those types of transactions, which would make them unattractive and therefore would diminish the ability for pensions to access that tool to increase the returns.
Thank you.